Ladies and gentlemen, welcome. It is that time of the year where our favorite super investors show us their portfolio and how to underperform the S&P 500. So here's what not to do. Old dog Warren Buffett bought 5 million shares of United Health. Michael Burry also added to United Health. Bill Gates bought more Microsoft and United Health. David Einhorn bought United Health. Leon Kopperman bought United Health. Carl Icahn bought United Health. Daniel Loheb bought United Health. Howard Marks bought United Health. Chris Hahn and Terry Smith both bought United Health. Seth Klarman added to United Health. Dodge and Cox bought United Health. Viking Global bought United Health. Everybody bought United Health. Thank you for coming to my TED Talk.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it.
This is the daily heat map of the S&P 500 and US stocks mostly stalled on Thursday as Wall Street digested a much hotter than expected PPI inflation print, souring optimism around a large September rate cut. And after hotter than expected inflation data, we saw a rotation into quality, and that quality being the mega caps. Amazon was up 2.86%. We saw the mega cap banks outperform and the mega cap financial. Look at JP Morgan, Visa, MasterCard, Wells Fargo, etc. Nvidia was up ever so slightly along with ABGO, but Microsoft also gained and so too did Oracle. However, most of infrastructure as well as software took it on the chin, and then Google and Meta were up ever so slightly along with Eli Lilly. And then everything else was pretty red. Most sectors actually fell today. And despite hotter than expected inflation data, like inflation hedges just didn't work. I mean, energy fell today. That was in the red. Utilities, that's an inflation hedge along with gold, down 0.63%. Real estate as well, down 0.7%. So very weird movement here in the market. We just saw again a rotation into some of these mega cap names. Look at the XLC. Look at the XLF. They gained with the S&P 500 virtually flat here. And you can see we sort of started the day off with every single sector in the red. And some found strength towards the end of the day. Most sectors were kind of flat. But the real losers today were small caps. Small cap growth really taking it on the chin today simply because of rate cut expectations, but we'll talk about that. And value and core across the board also fell for small caps. Mid caps, core and growth took it on the chin. It was a red day through and through, but really the place to be was large caps. They outperformed their counterparts. And again, it's just sort of that rotation into quality amidst this inflation uncertainty. It was red through and through. I mean, a mixed session here in Europe, but red everywhere else. Everything from North America to Asia. Deep in the red today on the back of the inflation data from the US. And this is the exact inflation data right here. You can see that the PPI month over month and core PPI month over month came in at 0.9%. That's nearly a 1% increase over the prior month. Insane. The market was expecting a 0.2 number for both. So very, very hot data. And then the year over year PPI rate came in at 3.7 versus 2.9%. So a massive miss. However, there was some good data. Initial jobless claims came in at 224 versus 228,000, beating expectations ever so slightly. And the same was true here for continuing claims. But the market was not focused on the labor market. We were looking at the massive inflation data right here, the massive miss. And that's why the market was moving today. But the S&P 500 was actually kind of flat. And that's because of a couple of reasons. When you actually dive into this inflation report, 25% of the inflation jump actually came from dry veggies right there. That jumped 38.9% for the month. So we can definitely see that like the tariff pain is starting to hit producers, and it seems to be starting with food producers. This is sort of not a good look for September cut FOMC members, but the S&P 500 pretty much flat today on a massive inflation miss shows the market only cares about one thing, and that's the Fed's reaction function. At the end of the day, the market is still pricing in a 25 basis point cut in September, and that's all the market is looking at, right? And that is why we were virtually flat today. Again, it's all about the Fed's reaction function, and the odds of a cut in September still at 76%. So the market still believes we're going to get a cut. In other news, the Chinese AI firm DeepSeek delayed its newest R2 model after struggling to train their model on Huawei's Ascend chips. Persistent issues meant training happened on Nvidia's H20, with Huawei's chip only used for inference. This is very, very bullish for Nvidia, and it means Nvidia is still number one. In other semiconductor news, Intel shares were jumping in the after hours, up 8% after Bloomberg reported that the Trump administration is considering taking a stake in the US chip maker Intel. Very, very bullish stuff. The stock was up 11% here and 8% after that news. Now, Netflix shares were up 2% here on the day, bucking the trend of the market after Netflix announced it had doubled its overall ad commitments during this year's US upfront and finalized deals with all major holding companies and independent agencies. Very, very bullish. And that is Netflix's growth driver, this ad business looking ahead over the next couple of years. And then John Deere, shares of the farm equipment maker, fell 6.7% as quarterly sales fell 9% from a year ago after reporting its earnings. Deere also narrowed its full year profit forecast, and profits for the third quarter came in lighter than expected, and the stock got sold off significantly. And then United Health was rallying 9.46% here in the after hours after Warren Buffett disclosed a $5 billion stake, as well as a ton of super investors buying this name. Stock was up 9%, and it does look like this 250 area is probably going to be the bottom for United Healthcare. And then for everything we've seen today, it was 1,900 advances, 4,300 decliners. We saw net inflows in the Nasdaq 100 and the New York Stock Exchange. And then market momentum, despite everything we saw today, market momentum continues to be above the 50% mark. However, when you look at the change from yesterday, we definitely did see a deterioration in the markets. However, the technicals are still extremely strong from everything from the 5-day all the way to the 200-day. Now, while the S&P 500 did actually gain today and the Nasdaq 100 was just in the red, it wasn't such good news for the RSP, the Russell 2000, as well as mid-caps, simply because these stocks were rallying on rate cut expectations, and those did get tempered a little bit today. And then you're going to see that rotation from these names, from small caps, from mid caps into the large cap names. That's exactly what we saw today. You could see a growth outperform value, and as a result, large caps. Now, futures looking a little bit green, as you can see right here. International stocks actually held up okay. Not so much China, but Middle Eastern stocks and European stocks were looking pretty good. I mean, if you look at the S&P 600, crypto took it on the chin, but crypto was ripping. And this is the type of volatility you see. Both Bitcoin and Ethereum were down 4%. But again, this is the type of vol you get with these assets. Bitcoin is like 30 vol, 30 ARR. Ethereum is like 50 vol, 50 ARR. So again, you're going to see quite a lot of volatility in these names. VIX did spike up ever so slightly, and then yields rose on the back of tempered rate cut expectation. Now, the dollar was up 0.42% today, and again, the dollar or cash is sort of like a safe haven asset. It's very secure. There's no volatility with it, and so the markets again, positioning themselves into the dollar ever so slightly, along with the other dynamics that we see here with the yield market. TLT was down 0.74%, and then we know that gold was down today. Silver was also down. They just opened the new day. Now let's talk about the S&P 500, and when you look at the weekly chart, things look really, really good. The market at all-time highs, making higher highs, making higher lows. However, when you get into the daily chart, you actually still see what is pretty good technicals, in my opinion. However, we are starting to see a little bit of a stall up here with these candles. This right here is a doji candle, and a lot of volatility in today's trade, especially when you look under the hood at the RSP. The average stock did actually fall significantly, masked by strength from the mega caps. And you can see right here, after we had this massive bearish engulfing candle and then move lower, bulls bought the dip, and we continue to move a bit higher right now. However, we are stalling right here, and ultimately, right, what the market is trying to reprice right now is Fed rate cut expectations. That's it. That's the name of the game. If the market can discernibly say we're going to get a cut in September and maybe one more before December, I think we're going to continue the rally. However, if we're only going to get maybe 25 cut for this year, I think the market's probably going to reprice that. However, I don't think we're going to see a massive move in the S&P 500 and the large caps, because look at what we did today. I think a lot of the selling is going to come in the RSP, but more specifically in the Russell 2000, mid caps and small caps, right? These are highly rate sensitive indices because just the cost of capital really impacts their business. They were rallying on the fact that we got a cooler than expected CPI, and now that is turned on its head. We're still getting a September cut, and I think that should buoy markets for the most part. But if we continue to get hotter than expected inflation data over the next couple of weeks, things can turn ugly. So we really have to pay attention to the data. Earnings season is behind us, so now everything is on the side of the macro. So that's what you want to watch right now, and that's going to determine where we go next. That being said, for the S&P 500, I'm still really liking the 62-65 area. If we do get to this level for the Nasdaq 100, I'm still liking the 22,955 level, call it the 23,000 level. If we get a pullback here, you want to be a buyer of those dips in the Russell 2000, right? That is sort of like this level right here, the 2167 area. But more specifically, I also do like the 2220 area, this area right here where we had a little bit of consolidation. If we do get a pullback here, those look like great dip buying opportunities, but we can suffer a deeper drawdown if rate cut expectations continue to move the way they did today. But we'll see how the market reacts. Again, if we look at the futures, right, things are looking fairly positive. So the market is sort of brushing this news off and pretty much saying, hey, we're still going to get a cut in September. And once rate cuts start, the average amount of rate cuts we actually get is about 75 basis points. So one cut will lead to many more cuts. It just depends. When do we get that cut? And what does the length of those cuts look like for the market? But for all intents and purposes, the market, the fact that the S&P 500 was flat is sort of looking past this data and saying, hey, the CPI was still pretty cool and September cuts are still on the table. European stocks were up 0.55%. This is the stock 600. We were strong buyers right here. And now we're looking to go ahead and retake this zone. Now, this is a heavy resistance zone. But if we can go ahead, break above here, we can then target these all-time highs and then price discovery for the S&P 600. Middle Eastern stocks, the ISRA, looking like it's trying to find a bottom right here and then rally. If we do, we can target some of these upper end ranges near the $54 area. And then Chinese stocks are moving, absolutely moving. You can see we're looking to get those 52-week highs at the $38 area. Looking at Ethereum, it's pulling back. I think even if we get a deeper pullback all the way to this 4,000 level, I think this is an opportunity to buy. I think 6,000 at minimum is the price of Ethereum at the end of this year. But if we look at the weekly chart, right, things still look largely constructive. I don't like this wick at the top here. On the weekly candle, however, things looking largely constructive for Ethereum, especially because we went ahead and broke above these key resistance zone. The problem here is that we put in an equal high right here at these all-time highs. It's not even an equal high, I wouldn't say. It's probably a lower equal high, slightly lower. So ultimately, what the bulls need to do right now is find support wherever that support zone is. If we just go on the daily chart, right, you can see that support could come here at the 4,200 level. Ultimately, the strongest support will come at the 4,000. So let's say we continue to move lower here for Ethereum. We need to find support at these levels and then continue to move higher, right, and break above that 5,000 area, that all-time high area. That is ultimately what we need to do. If that isn't the case, that's going to look like a slightly lower high compared to all-time highs. And then that doesn't look too good. And then we could actually open up lower levels if we can't go ahead and break those all-time highs. So digest this massive move we've had, pull back, find support, and then onward and upward to all-time highs. That is what the bulls need to do. The bulls acted very strongly right here. It's time for the bulls to act again. However, a little bit of breather would be welcome. Looking at Bitcoin, so we went and had a closing all-time high yesterday, and then we just puked all the way down back into this digestion zone right here. For Bitcoin, we do know that entry mining supply is telling us we will go higher. And ultimately, if you miss the rally all the way, this is a dip buying opportunity. I think buying Bitcoin anywhere in the teens is a very solid play. Buying Bitcoin anywhere in the 100, buying Bitcoin in the teens, anywhere from like 113 to 119,000 is probably prudent because we're probably going to go to 140,000 before the end of the year. So that is definitely on the cards.
And diving into sentiment, this is the AAII sentiment survey, which asks, what direction do AAII members feel the stock market will be in the next 6 months? Are you bearish, bullish, or neutral? And sentiment has swung sharply bearish, as you can see in recent weeks, especially from 2 weeks ago, as markets are sitting at all-time highs. Bullish sentiment 2 weeks ago was 40, now under the 30 mark. Very interesting. And such pessimism, or such a movie pessimism during record highs, can be a contrarian signal, suggesting that despite stretch valuations and macro and geopolitical uncertainty, many investors are still positioned cautiously rather than euphorically. Looking ahead, this wall of worry could provide fuel for the rally if fundamentals hold up. But it also hints at fragility, and negative surprises could quickly validate the bearish momentum. So it's all going to come down to the fundamentals and the macro. And when we look at the fundamental picture, the real key driver of the fundamentals is earnings. And earnings revisions has been very positive here in recent weeks since the tariff tantrum or Liberation Day lows. In fact, we've seen positive earnings revisions to the S&P 500, supporting the market at all-time highs. At the same time, rate cuts are officially on the table. We got a cool inflation print that is giving the Fed the optionality to cut rates. And right now, the market, at least the betting market, is pricing in an 81% chance of a 25 basis point cut in September. And this is what happens when the Fed cuts rates during a soft landing or when we have no recession. Markets after the first rate cut can see returns in excess of 20% 1 year later. However, if we do enter a recession, which we're not, and we'll talk about why, we can see a drawdown of about 15%, but the macro is telling us we're probably not going to get a recession. The US Economic City Surprise Index is actually above the zero line, and it has been that way for the last couple of months. And before that, right, we were actually deeply in positive territory. If you're above the zero line right here, economic data is coming in better than expected. Below, it's coming in worse than expected. And we've seen market data coming in roughly in line, some misses, some beats, but roughly in line and sitting just above the zero line right now. And the biggest parameter of the market is the labor market, right? And right now, when we look at federal employment tax receipts, because this is the best parameter for the consumer and for the employment market, that's 7.8% growth up until August 8th. Very, very solid stuff. The previous month was 7.4%. The previous month before that, which was June, 5.9%. May was 5%. And over the last 12 months, we've seen 6.3% increase in federal employment tax receipts. That is not bearish. That is telling us that disposable income, employee income is really, really strong. And as a result, the labor market is most likely very, very strong. Now, looking at data for the rest of the week, tomorrow, we have big data, retail sales and the Michigan consumer sentiment. We don't really have anything with regards to earnings, guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.